So what is the property equity? So let's decode from there itself.
In simplest terms, I would say property equity is the difference between the current market value of your property minus the current liability against it, i.e. the loan amount. So to give you an example, if let's say your property value in this market is 1.2 million and your current lending against it is 900k, then your total equity is 300k.
Now, what is the difference between the total equity and usable equity? So I'm assuming as a layman, if like you said that if the property value is 1.2 million and there is a 900,000 liability on it, so the equity is 300,000. So out of these 300,000, how much is the usable equity for my next investment?
Yeah, good question. That's a question that gets asked a lot and trips up a lot of people.
Somebody who is planning to buy the next property to live for themselves and for the family, and somebody who is planning to invest in an investment property. So how is this equation works?
A house to live in yourself, we call it owner-occupied property. You only need 20%, but if you're buying an investment property, in most cases you would need 30%.
Hi, hello everyone. This is Chakit and we are sitting with Gaurav, our financial expert. And this is our fourth podcast, and now we are taking this ahead in terms of the journey of you investing in New Zealand and especially property market. So this podcast is about how to unlock your property equity in New Zealand market and how to get the maximum value out of it. So in first three podcasts, we discovered when you're starting off your journey being the first time investor. In this podcast, we are going to discuss about how to use the equity which you have built over the period of time and how you can unlock the maximum potential out of the investment which you have already made. So welcome, Gaurav.
Thank you.
And let's start with today's another informative podcast.
Let's do it.
Great. So can you please help us understand the whole concept? So we're going to break it down into different segments, like what exactly is property equity. We are going to discuss about what is the difference between total equity and usable equity. So you will help us decode these terms in a simplest manner so that the people who are trying to invest or trying to buy their second home, or they want to have another property which they are going to use for their wealth creation. So let's focus there.
Sure.
So what is the property equity? So let's decode from there itself.
In simplest terms, I would say property equity is the difference between the current market value of your property minus the current liability against it, i.e. the loan amount. So to give you an example, if let's say your property value in this market is 1.2 million and your current lending against it is 900k, then your total equity is 300k.
Great. Now, what is the difference between the total equity and usable equity? So I'm assuming as a layman, if like you said that if the property value is 1.2 million and there is a 900,000 liability on it, so the equity is 300,000. So out of these 300,000, how much is the usable equity for my next investment?
Yeah, good question. That's a question that gets asked a lot and trips up a lot of people. Usable equity is essentially the amount of money you can withdraw against your property. So to give the same example again, if the property value is 1.2 million and your current debt against it is 900k, and if it is your owner occupied property, the bank could allow you to go as high as 80% of the market value, which is 960,000, which essentially means that you can withdraw 60,000 in your usable equity or serviceable equity, and that's essentially what you can use towards your next purchase or do house renovations or buy a vehicle. We'll go through that in greater details as we go along, but that's what we call the usable equity.
Great. So it is the difference between, in layman terms, it's the difference between the equity which you need to leave behind in your existing property, and whatever is the extra which you can use for your next investment.
Correct. And the leaving behind part is dictated by RBNZ.
Uh-huh.
So for owner occupied, it has to be 80%,
Mm-hmm.
and for investment property, it has to be 70%
Great.
of your current property value.
Current property value. Great. Now, how is usable equity calculated on an investment property, like you just mentioned? So let's somebody who is planning to buy the next property to live for themselves and for the family, and somebody who is planning to invest in an investment property. So how is this equation works?
So in this case, I would use a slightly different example. Let's say you have an investment property in west of Auckland. The current market value is $1 million, and your current debt against it is 500K. Being an investment property, you can go as high as 70%, again based on RBNZ guidelines. So you can essentially withdraw 200K more to go up to 70% of the market value, which you can then use towards your next property purchase. If you're buying a house to live in yourself, we call it owner occupied property, you only need 20%. But if you're buying an investment property, in most cases you would need 30%, even though there are certain ways we can still make it work with high LVR as well.
Next question is, how can equity be used as a deposit for another property? So what is the formula behind it? What is the psychology behind it? If you can just throw some light on it.
See, we spoke about usable equity. So that's first and foremost consideration. Let's say that you do have an ability to withdraw 200K from your existing house. As a next step, we need to look at your servicing power as well. It's all well and good to have usable equity, but the banks don't go just by that. They also look at your borrowing capacity. So that essentially means your income and other sort of debts. And if the numbers check out, then you can essentially use that 200K towards a deposit for your next one.
Can you share some example, like recent cases you might have dealt with similar kind of scenarios?
Yes, I'm actually helping a client who wants to buy $2.5 million owner-occupied house in east of Auckland. So they currently have roughly 600K sitting in their house equity, and they want to upgrade themselves to go into the McLean zone. And for that, they essentially need 20% to go towards a deposit. So we've helped them get a top up from the existing bank for that amount. And then for the remaining amount, we use a split banking strategy, and we are sorting out the lending for the remaining $2 million from a separate bank.
So what is the split banking in strategy?
I'm glad you asked. So we tend to suggest our long-term investors to have their properties at different banks, not hedge their bets against one entity. And what that really means is you're not cross-collateralizing your assets in just one bank, and there are multiple reasons to do so. The other bank might have better borrowing power to lend you more. You might get better cash back. There might be a better restructuring option for you. So it's always good to have multiple options available at your doorsteps, and that's where we suggest that if you're buying another property, then you look at going to another bank for that particular.
So basically, you mean that if they have one loan with, say, BNZ, and then what the second loan which they are going for, the second property, they keep it with ANZ, so that they would be able to take the benefit of the
Both the
offerings
banks.
from both the banks.
Yes, absolutely.
Okay, perfect. And can someone buy an investment property without contributing any cash?
Potentially, yes. If you have sufficient equity, then yes, you can use that towards a deposit. And as I said previously, by and large, you kind of need 30% to go towards the investment property purchase. But there are certain lenders and certain guidelines which allow you to purchase your investment property with as little as 10%. You end up paying higher margins on interest, but that's still a possibility.
So even with 10% as an investment property, you can buy.
Yes, absolutely.
Okay. And is there any other cost involved in this process apart from just getting the refinancing thing done?
Yes, there are a few factors that the buyers need to be aware of. Break fee is one that gets called a lot of times. Say an investor wanting to switch banks in order to leverage their equity, but they are locked in for another 8 months with their current bank. If they move now, there might be a break fee they may have to pay to their existing bank. There could be a cashback clawback as well, which generally ties you in for 3 years from the date of purchase. And if you switch banks before that, then you potentially have to pay a certain portion of that back. On top of that, there is refinancing cost, i.e. solicitor fee, which would be part of the overall consideration if you're switching banks. And then, whatever else you require in terms of registered valuation would also be consideration you need to have while
कभी आपने
thinking
ऐसा भी देखा है
cost.
कि everything is looking rosy from outside and someone think they have plenty of equity but banks still decline their loan, ऐसा भी होता है?
होता है, बिल्कुल होता है.
हाँ.
See, having equity is one thing, but having the servicing capability is another. It's all well and good कि आपके पास $2 million की equity है, but if you are not earning sufficient to, let's say, purchase another house worth $1 million, the bank won't allow you to leverage that equity, because end of the day, the way banks see it is that it's a debt that you're taking on top of your existing debt.
Yeah.
And as long as you have the servicing power, great. If you don't, they won't lend against it.
So ये जो टर्म है सर्विसेबल इक्विटी और सर्विसेबिलिटी, इसको कैसे डिफाइन करते हैं? तो थोड़ा इसको ब्रेक डाउन करो एज अ लेमैन कि व्हाट इज एग्जैक्टली सर्विसेबिलिटी मीन्स.
So when it comes to equity, we generally play in the LVR sort of space. LVR basically means loan to value ratio.
Yeah.
For owner occupied, the guideline from RBNZ is 80%. For investment, it's 70%. Okay. तो अगर आप उस स्पेस के अंदर हैं तो you can withdraw the equity potentially.
Yeah.
But at the same time, so to give you an example with numbers, again going back to the first example I used, your property value is 1.2 million. Your current debt is 900K. Now you could potentially take another 60,000 out from your existing property and use that towards house renovations or purchase an asset. So we call that usable equity. But if you had a pause in your career, you're not earning anything from last 8 months, the bank would want to see if you can still pay that additional 60K off. And if the answer is no, they won't lend against it. So that's why, look at serviceability along with the usable equity. One without another won't lend you anything.
But on the flip side, like throw some light on it. On the flip side, if you started making more money, so last year the family household income was say 150K. This year, both husband wife, they got a pay rise or they changed the job, and the current salary is say 200,000. So will that going to affect the future approvals, or how does it calculate it in terms of will they be able to get the higher loan for the next loan they are taking?
Potentially, yes. They would have better borrowing capacity, i.e. serviceability. So अगर 150K की combined household income से उनकी servicing 800K के lending के लिए बैठती हो
जी,
अभी it may be possible that they can go up to $1 million. But then again, as I'm saying, that you have to look at it in conjunction with your equity or deposit. If you don't have enough equity or deposit to say put 10% of the property purchase, you're still restricted in terms of how much higher you can go. So these two need to be looked at in conjunction. Servicing, yes, you can increase that with your income, but at the same time you kind of have to look at whether you can leverage more equity towards your deposit. अगर आपके पास equity नहीं है but आपके पास savings हैं which you built up based on your extra income, then yes, you can use that towards
So
the
let's say
deposit.
if
So in
they
that case,
save enough funds for the next 6 months and then use that combining, so some portion of equity, some portion of savings, higher income, so they can definitely upgrade.
absolutely. In fact, I've had scenarios where people bought 3-4 years ago at the peak of the market, where let's say that they purchased their first home at a slightly premium price, but unfortunately the property market has
Tanked from there.
tanked from there, or by and large Auckland, Wellington जैसे regions में 15-20% drop आए हैं on average.
जी.
So they're kind of sitting at very low equity, or in some cases negative equity as well. And their circumstances have changed, their incomes have gone up, they have more members in the family, and they want to upgrade. So in those cases, if their intent is to move into a new space to live in, we can still look at it with as little as 10% deposit. So that's still doable, but unfortunately they can't use the equity from their existing home because there's no equity on paper.
Now there is another term which is widely used in the industry, which is debt to income.
Yeah.
So we want to touch upon that so that anybody who is planning to do the investment, they need to know about how do the DTI rules affect equity release.
Yes, it's a very important subject, to be honest. Back in old days, when DTI wasn't in the picture, the banks would lend against any sort of income. So, for example, if you don't have a lot of active income, but you have a lot of passive investments through which you're earning,
Yeah.
you can essentially leverage that and buy more and more. But the banks introduce what they call speed limits, which is part of the DTI ratio, that for an owner occupied, you can only go as high as 6 times of your gross income.
Okay.
And for investment purpose, you can go as high as 7 times of your gross income.
Okay.
So these rules have been brought in, I think, from 1st April 2025 to ensure that you don't over leverage if you are relying purely on rental investments.
Okay.
So this is essentially another RBNZ policy to make sure that the property investment stays healthy and there's better opportunities for first home buyers as well, and not just investors running away with it.
Amazing. So these are the important things which everybody should keep in mind, especially in the investing part.
Yeah.
Okay. So next thing is, do unused credit card affect equity release?
It does. Again, one of those myths that if you have a credit limit of 20,000 but you're not using it, you're fine. End of the day, banks would still look at it as your debt or liability. Okay, so it will still come into consideration. Doesn't really matter whether you have used only 1% of it or 99%. It will still be treated as 100% liability against you. So in many cases, we end up having conversations with the clients, explain it to them the need to reduce the debt if they're not using it actively. So maybe for you from 20,000, you can drop it down to 5,000, and that helps you in your servicing power.
So the next question is, how does a bank establish the property's current value?
Right. Okay. There are 3-4 different channels through which banks generally assess a current property value in this market. One is software value. There are certain certain platforms like Velocity or CoreLogic, which we generally have access to, and we can go and check what your house value currently looks like. It gives you a sort of ballpark. It's not always accurate because it's sort of relying on nearby sales, but doesn't necessarily know if you've done any recent renovations inside your house. But it's kind of there. So that's one. The other one is registered valuation, which is like the master of all stories. So if you have done extensive work in your property, but it's not reflecting in your CV or your software value, you can always rely on registered valuation, which is done by a qualified valuer who comes and visits your property, looks at everything, what you've done recently, and how that stacks against what's going on in the
which was already
nearby
there.
suburb and the larger market, and then they come back with the value of your property as in today, and that's generally seen as more reliable by the banks. And a lot of cases where, you know, if the property was run down but has been recently renovated, or there has been a major change, whether that's in terms of title or anything, the banks do ask for registered valuation. That's two. Then CV is obviously there. If there's no history to it, the banks can rely on CV as well in certain cases. And fourth, but not less important by any means, is your purchase price. So if you're going in an auction and buying a property, then the purchase price sort of dictates the value of the property.
According to my research, like I went to see one address on Auckland City Council website. I put down the address and the CV is showing say 800,000. And the property was bought for, let's say, 680. So how does this CV value and the
actual
market
price?
value which has been paid, how come there be such a huge difference between the two?
That has been an age-old conversation. Look, CV is sort of dictated by a point in time value of the property. So for example, the current CVs we are looking at is from June of 2024, if I'm not wrong. But the market has moved since then. And as we often say in our industry, the value of the property is the price the buyer is willing to pay, right? And that gets dictated by the sentiments in the market, inventory, whether there's surplus or shortage, demand and supply equation. So many factors come into play. As financial advisors, we often have this conversation with our clients that don't just blindly look at CV or value indicators on free online tools. We can help you with more
Realistic,
accurate representation of it. We can't always be 100%
correct,
accurate on this, but we can give you a range. But if you really want to be absolutely sure, then you can always get a registered valuation done, and that more or less gives you the true value of the.
Going ahead, so somebody who paid higher value of the house, with it might be in the auction or might be a family member got really enthusiastic about that property. So does getting a higher valuation create equity?
It doesn't create equity. It does allow you to leverage that equity. So the equity is what the value of that property is in this market. So again, if it is purchase price, then yes, the banks would look at it during settlement. But 6 months down the line, that may not hold true. They may want to get a registered valuation done. So yes, you can do registered valuation to leverage that, or you can purchase it at a higher price, and that gives you a step forward in that context. But it doesn't unlock the equity for you as such. It just allows you to build that equity and then sort of use
So
it
it's
later.
more like just parking your money in the bank and then it's your own money. So instead of doing that, you can just actually buy the house in the fair price and then use the remaining to buy another one.
Probably. Yes. Smart investors do that all the time.
Now, if somebody already have a loan, should someone top up their existing bank or refinance to another bank?
There's no single answer to that. It just depends on your personal circumstances and your end goals. In many cases, getting a top up with the existing bank is probably easier because they know about your financial situation and your overall circumstances. And if you're just going to them for an amount, let's say in 5 digits, you would get approved quicker, and you wouldn't have to pay any solicitor fee as well. You may want to look at refinance in case you are looking to restructure it slightly differently or want to avail better cashback or better rate elsewhere. But you do need to be mindful that you may end up paying a solicitor fee for that refinance.
And does refinancing itself increase someone's equity?
No,
Not
by itself. As I said, you can leverage it while refinancing, but just by refinancing, you're not going to build more equity.
But let's say, okay, there is one example just came into my mind. Somebody was at say 6% interest rate. They moved down to 5% interest rate. That 1% which they were paying, if they keep on paying the same mortgage EMI which they were paying before, eventually with the period of time they will be building more equity?
Yes, absolutely, because
Yeah.
then you're paying more towards your principal than your interest.
Yeah.
And if you're looking at it over a 24 months period, you might have paid 20,000 more, and that could potentially unlock that much amount in equity for future renovation or future, investment property purchase purpose. Yes.
Okay, great. Now, what happens if somebody upgrade their home but keeps the existing property as a rental?
Yes, so you can certainly do that. I suppose the question here is whether you need to withdraw the equity to purchase a new house. In that case, you need to disclose your intent clearly. And if the intent is to keep the existing house as rental, then you can potentially withdraw up to 70% of that house in usable equity, and then use that towards a deposit for the next purchase.
So then you have to tell to the bank that the next house you are going to, that is where I'm going to live, and the existing one is going to be for the rental purposes.
Yes,
So
absolutely.
how do the bank calculate the income which you will be getting from the rental?
So we can rely on rental appraisals, which you can get done through your property manager, or we can use tenancy services website just to get an indicator from there. But the part that you need to be mindful here is when you're going to your existing bank and saying, "Hey, I used to live in this house. Now I want to buy another house." The bank won't just give you the money as is. They would want to know what sort of property you're buying, whether you're buying the next house for 900K or 3 million, because that also forms part of your overall servicing power. And it's the lender's responsibility to be responsible in terms of lending you that amount. So they look at the larger picture, not just look at it in abstract value and say, okay, because you just have equity in the house, you can take it and do whatever with it.
So
They would want to know
basically,
that.
what I'm getting from this conversation is, so your income, what you're currently making, the money which you have in the saving, the money which you have already repaid to the bank, the interest rate on which your previous loan was financed, and the loan which you are going to get in the future, plus the market value of the house which you are going to buy, and it is for your own living or for the investment. So there cannot be just one factor which
No.
will drive, okay, you go to the market, you pay $5, get the burger and done. It's not
Exactly.
like that.
It's not like that. And
Yeah.
that's why I wanted to have this conversation. And
Yeah.
I'm glad that you brought it up, because
Yeah.
equity can be misunderstood in so many different ways. People say, oh, I've got equity in my house, but is it total equity? Is it usable equity? And what exactly do you want to do with that? Also, is an important factor in unlocking that capital, because you can't, as I said, you can't just walk into the bank and say, I've got 700K sitting in my usable equity, give it to me now, but I'm not going to tell you what that is for.
Yeah.
So the bank would want to know that, because they have the responsibility to lend in the right framework and right structure.
I have another scenario. Somebody, a couple, lived in a house for 5 years, and somehow they managed to repay the entire loan. So that means they are sitting on 100% equity,
Potentially, yes. I mean, 100% total equity, not the usable.
not the usable. Now, let's say they want to buy two properties at the same time. So let's say if they withdraw 70%, because obviously it's going to be an investment, what they're going to, they cannot say to the bank that they are going to live in two houses at the same time when they
Yeah.
already have one. So that is going to be in the investor category,
Yeah.
where they can only withdraw 70% of the equity, right?
I'll frame it up slightly differently.
Okay.
I know where you're coming from.
Yeah.
So let's say that the house value in this market is $1 million,
Yeah.
and they paid all their debts
All of
off.
it, yeah.
But their plan is to still live in that house and buy two investment properties.
Yeah.
Right?
From the same equity what they have in the existing house.
Yes,
They don't
so-
want to pay anything upfront.
Yes. So we'll look at their intent. Their intent is clearly to live in that house. So in that case, they can leverage up to 80% of the total equity in usable form, which essentially means 800K. And if you're buying two separate properties, which is very rare that people go for two separate properties at the same time, but let's just roll with it. 800K is what you've unlocked, and you're using
like let's say they're buying $1 million each. So the two houses, another $1 million. So they have 40% deposit now with them.
For each one of them.
Yeah. And so let's say, and their income is also the same. No increase, no decrease, is same. And if the rent is covering up the rest of the mortgage part, so technically they don't have to pay anything.
Technically no, but then again, the banks would look at the overall servicing. So now what you've done is you've essentially taken $2 million in additional debt, 800K from your existing usable equity, and 1.2 million across two separate properties as your fresh funding. So now combined debt on you is 2 million. So the banks would assess whether your current gross income along with your rental income, future rental income, can allow you to service $2 million worth of debt.
So in that case, if the couple is still making, let's say, how much should be their income in that case scenario? So if you divide it by 7, so it's like 300K. Am I correct?
Yeah. So I mean, by and large, you're kind of looking at 6 to 7 times.
7 times.
So you can do your maths. I mean, you kind of need somewhere closer to 250, 300K.
Okay.
But again, there are so many different factors. What sort of rent are you going to get from the other house? Do you have any boarders living with you? So there are a few levers that we can pull in terms of what you really need to make it happen. But by and large, yes, you kind of need to be in that.
So theoretically, it's possible.
Yes.
But the income has to be in somewhere in the range of 250 to 300,000 a year.
Combined income
for
rental, yes.
2 people. Great. Okay. Now, what is cross-collateralization?
I think I kind of touched upon that. Cross-collateralization is essentially a term coined where you have multiple properties secured with one bank. So the example you used, that you have one property with no debt against it, but that's still secured by the bank, and you're wanting to buy 2 more properties. The same lender can allow you to purchase those 2 properties using the first one as collateral. Right? Because on paper, you're not really moving that fund from one place to another. You're sort of keeping that within the same framework with the same bank, but you're leveraging that to buy 2 more properties. So now what would happen is, instead of that one property, you have 3 properties with the same lender. And the way they allow that to happen is by cross-collateralizing it. That one, your existing property sort of acting as a beacon to
So that's the base, and then you're branching out with to another one using the same equity what you have with the first one. Okay.
So your risk kind of becomes shared across 3 properties. And if you, let's say, want to sell one of them in the future, then the banks look at your overall portfolio and not just that property in silo, because they're all now collateralized across the board.
And can someone release equity from one bank and purchase through another?
Yes, potentially you can do that. But as I said before, you kind of have to look at various factors such as refinance cost, break fee, cashback, clawback. If the numbers stack in your favor, you can do that.
एक थोड़ा दर्द वाला question है. What happens to equity when property price falls?
Definitely painful है ये, especially last 3-4 साल में, क्योंकि उस चीज़ के बारे में थोड़ा सा point out किया कि काफ़ी लोगों ने around 21, 22, they bought their first homes at a premium price, और unfortunately अब उनकी equity drop हो गई है significantly. So in that case, they kind of stuck. They have few options, but fairly limited in that context. We can always look at refinancing them for a better cashback or better rate. We call it dollar refinance. But unfortunately, the harsh truth is they can't use their equity anymore. So if their plan is to buy another property, then they kind of have to rely on their hard-earned funds to put towards a deposit.
Another scenario just came to my mind is, let's say they kept up with the mortgage repayments for the same amount without disturbing that. But in the meanwhile, they also happen to save bit of a money. And the income is still stable. The income which was there in their previous mortgage. Will the bank be able to give them another loan as an investment property, since the prices are down, and they might be thinking that if we buy another one, which pretty much mitigates the, like how you buy the stocks, if the price keeps on falling down, you keep on averaging them down, so that eventually you will have a better price for the same stock, and once the price start going up again, you still make profit. So is this possible in this case scenario?
Yes, it's possible, but probably not with the same bank. So the cross-collateralisation term we used, that's where the RBNZ LVR speed limits kick in. If you're already sitting at 90% LVR for one of your property, the same bank would probably struggle to lend you against the other house with 80% or 90%. But we can always look at split banking in this case. I've had scenarios where the clients bought their house again 3-4 years ago, but अभी उनके 10 या 20% ही equity है उनके पास, but they want to move out of there and put it on rental. They do have 10% cash. तो उन cases में हमने उनको help की है जहाँ उन्होंने using that cash they bought their new owner occupied property and moved in seamlessly.
Great. क्योंकि ये सवाल बहुत मन में आता होगा ना कि यार अभी प्रॉपर्टी के रेट डाउन है, तो किसी तरीके से अगर हमारा बन जाए बात,
दूसरी प्रॉपर्टी आप एक अच्छी वैल्यू पे बाय करो, ताकि फ्यूचर में जब
दोनों के प्राइस बढ़ेंगे तो एवरेज आउट हो जाएगा.
यस, एब्सोल्युटली, बहुत होता है. और साथ साथ ये भी होता है कि काफ़ी लोग ट्राई करते हैं कि उनको एग्जिस्टिंग घर में टॉपअप मिल जाए. वो अगर आपकी यूजेबल इक्विटी नहीं है तो अनफॉर्चुनेटली दैट्स नॉट पॉसिबल. सो दे फील लाइक दे स्टक, दे वांट टू अपग्रेड बट दे कांट डू एनीथिंग विद देयर एग्जिस्टिंग हाउस. सो इन दैट केस द सेंसिबल ऑप्शन,
बेच भी नहीं सकते और रह तो रही हैं.
हाँ, तो इट्स लाइक
अपॉर्चुनिटी मिस भी नहीं होनी चाहिए.
एग्जैक्टली. तो उस केसेस में उनके लिए यही एडवाइजेबल है कि दे लुक एट अदर एवेन्यूज, आई मीन moving elsewhere, and you kind of have to have at least 10% for that, ideally 20%.
और इन्वेस्टर हमेशा ये सोचते हैं कि चाहे छोटा इन्वेस्टर हो चाहे बड़ा इन्वेस्टर हो, कि कैसे पैसे बचाने हैं, क्योंकि जो पैसे बचेंगे उसी से ही पैसे बनेंगे. सो इज इंटरेस्ट रेट ऑन एन इक्विटी टॉपअप इज टैक्स डिडक्टेबल?
अगेन डिपेंड्स ऑन द इंटेंट फॉर द टॉपअप. अगर आप उस टॉपअप से एक इन्वेस्टमेंट प्रॉपर्टी ले रहे हैं, यू कैन यूज दैट पोर्शन ऑफ द टॉपअप एज टैक्स डिडक्टेबल. बट अगर आप उससे कोई व्हीकल बाय कर रहे हैं या अपने एग्जिस्टिंग घर में रेनोवेशन करवा रहे हैं, तो दैट्स नॉट अलाउड बाय IRD फॉर यू टू पुट टुवर्ड्स योर टैक्स डिडक्शन,
क्योंकि वो डबल टैक्सेशन में जाएगा इस वजह से.
आई मीन इन जनरल रेंटल इन्वेस्टमेंट्स आर टैक्स डिडक्टेबल. तो अगर आपने कोई और प्रॉपर्टी लेनी है, ऐसे अगेन $1 million की, और आप 700K का लोन ले रहे हैं एक सेपरेट बैंक से और 300K आपके एग्जिस्टिंग बैंक से ले रहे हैं, एज लॉन्ग एज वी कैन शोकेस कि आपकी इंटेंट क्लियर है कि वो 300K इज गोइंग टुवर्ड्स दैट हाउस, यू कैन बेसिकली डिडक्ट टैक्स अगेंस्ट द होल $1 million वैल्यू. बट don't take my words for it.
Consult the financial
accountant से बात कीजिए. हाँ, but that's generally how I've seen it working.
Perfect. And what is the biggest misconception about equity? क्योंकि इसमें भी तो होता होगा ना कि मतलब somebody is just thinking कि I'm sitting at this much equity, which they might not have an idea about how much is the usable one, how much they can withdraw, or how to service the loan. Once, like even if they got the equity, they need to still prove that they have enough income to service the loan. So कौन से ऐसे misconception हैं जो आपको regularly देखने या सुनने को मिलते हैं?
Two things come to mind. पहला ये है कि जो सिनारियो अभी हमने डिस्कस किया कि जहाँ पे उन्होंने 90% लोन टू वैल्यू रेशो पे घर लिया था, they've paid 5% of it, let's say, and they come to you and say कि अभी मुझे घर में कुछ और काम करवाना है, can I withdraw that money out?
Yeah.
So again, the RBNZ, जो LVR restrictions are those kick in. Unfortunately, if you are sitting at more than 80% LVR, you don't have any usable equity. तो आप उस पैसे को नहीं withdraw कर सकते. You can't ask bank for another 5% for that. There is one lender potentially who can look at it case by case for first home buyers, but by and large that's not allowed. और काफ़ी लोग ये question पूछते हैं जो first home buyers होते हैं especially. Second one is around how we look at the LVR position after you purchase a house. You moved in, आप रह रहे हो वहाँ पे और आपका refix अभी आने वाला ड्यू है and you feel like you are paying higher margins. वहाँ पे we can look at your current property value versus your current debt और उसके basis पे we can evaluate कि अगर आपकी sort of जो extra margins है वो reduce होने चाहिए कि नहीं होने चाहिए. Basically आपने equity build की है कि नहीं. अगर आपने ज़्यादा equity build की है from the time you purchase the house, चांसेस आर कि वो जो हायर मार्जिन्स आपको लगे थे हम उनको कुछ रिड्यूस करवा पाएँ या बिल्कुल वेव ऑफ कर सकते हैं. सो दोज आर द कन्वर्सेशंस वी टेंड टू हैव विद आवर क्लाइंट्स व्हेन देयर लोन इज कमिंग अप फॉर रिन्यूअल. वी ट्राई टू हैव दैट कन्वर्सेशन फ्यू वीक्स इन एडवांस ताकि हम
we get enough time
assess
to
कर
work
पाएँ
out
कि
the
हाँ
numbers.
क्या स्ट्रैटेजी रहनी चाहिए, whether doing a registered valuation would help, staying with the same bank and requesting a waive off would help, or refinancing them to another bank would be a better option.
And जो ओनर्स के दिमाग में एक आता है कि अभी मेरी इक्विटी की एक्चुअल वैल्यू है क्या, इसको एग्जैक्टली ब्रेक डाउन करना हो कि मतलब टू द लास्ट डॉलर कि एक्चुअली में मेरे पास कितनी इक्विटी है, इसका करेक्ट फॉर्मूला और मेथड क्या है?
जैसे मैंने बोला कि आपको पहली चीज़ जो फिगर आउट करनी है वो ये है कि आपकी एग्जैक्ट करंट मार्केट वैल्यू क्या है. एंड अगेन डिपेंड्स ऑन योर ऑब्जेक्टिव बिहाइंड डूइंग दैट असेसमेंट. अगर आप डेस्कटॉप वैल्यूएशन पे रिलाई कर रहे हैं तो वी कैन हेल्प यू विद दैट. वी कैन फाइंड आउट व्हाट योर करंट मार्केट वैल्यू लुक्स लाइक, compare that against your current lending and give you a sort of high level view of where you stand with your equity. But अगर आपका सिनारियो ऐसा है कि जहाँ पे आप हाई LVR पे हैं and you really want to come down under 80%, then chances are कि registered valuation would come to rescue based on certain improvements you would have done in your house, or you feel like in general your property value should be higher.
Perfect. So guys, this was our message to you. If you are planning to go higher on the property investment ladder and you are thinking of how to maximize the chances of the higher ROI, then Gaurav is the guy whom you should be talking to. He, like you must have seen in this video or the previous ones which we have done, that he has got in-depth knowledge of understanding the holistic profile of somebody who is trying to make the investment and give you the overall picture where you will be able to maximize the chances of getting the best deal from the bank, best interest rate, how to split and manage your finances to actually keep you floating in the safe waters. All you need to do is, there is a link in the description, click that link, get in touch with him and he'll be more than happy to help you. And just to make it clear, there are no service charges, so all you need to do is just get in touch with him and he'll take care of it from there on. Anything
Exactly.
else you want to add on?
No, I think you articulated it well. Just wanted to say that yes, a lot of people are struggling trying to float above the waters, but that's where we raise our hands and say, look, we can help you.
Yeah.
We can't turn the world around for you, but we can certainly help you with the right strategy. It may or may not work for you in the near future, but we can certainly help you in the longer run. So by all means do reach out to us. Our services are for free and then we would love to help you.
And we are just trying to build up a relationship with you from today point onward, because if you are serious about building wealth in New Zealand, property is one way where you can actually make it happen. Because once you branch out from your first home to another one, you're already way ahead from most of the people, and the rental income which you are going to make from that house is going to pretty much contribute towards 90 to 100% of your future payments toward your mortgages, until unless something adverse happen. But if you are planning towards that financial freedom and want to build the wealth, then do get in touch with Gaurav, and he'll be more than happy to help you with the entire process. So this is Chakit and Gaurav signing off.
Thank
So
you.
take care of yourself, and we shall see you in our next video. Till the time, you guys take care. Bye bye.
Bye.